Hello, dear students. In this session, let us understand about trade-off theory, which comes under the concept of capital structure. So, capital structure is again the proportion of debt-equity mix. So, how much equity that we are gathering for running the business, even from shareholders, that is preference, how many borrowings that we are collecting. So all these things put together, that proportion, that ratio, that mix is actually called as capital structuring. So this theory, it comes under that capital structure concept. Let us understand this. So the trade-off capital structure is basically a financial theory that suggests that a company should balance the costs and benefits of various sources of financing. See, there are major two sources. One is debt, another one is equity, as we all know that. Okay, so how should balance this debt and equity? Okay, only equity is not preferable, only debt is not preferable. Both equity and debt put together. So how we are balancing for smooth procurement of financing, right? And we say this concept as optimum capital structure. Optimal capital is clear capital structure, okay, without affecting your business, like how these two, debt and equity financing to be balanced, okay. And this optimal capital structure, it actually differs from company to company. All the companies, they will not follow the same level of optimal capital structure. Like this is what the equity, this is what every companies, they won't follow the same structure. It differs from industry to industry based on the business risk, tax, all these things, okay. And next is, so what are all the factors basically it affects this trade-off theory, trade-off model? First one is cost of financial distress and bankruptcy. Okay, so that is the major or the first factor we should consider. Okay, so based on industry, its size, its model, okay, cost differs. Obviously, cost differs. So some companies with high fixed cost, some companies might have less fixed cost. Okay, so its operations, it differs. Every industry's its operation is actually differing from each other. Okay, so that might be the different reason. Okay, see, compared to service oriented business and production based companies, that is different. Because of those reasons, cost definitely it has many it need to face many financial distress. Okay, so that is the first factor. And second factor is tax benefits. Tax benefits in the sense tax deductibility of interest payments. Okay, so that also differ based on the laws and regulations that what we are following in our country compared to other nations. Okay, and next is market conditions in the sense like depending on the market, basically we can say interest rates, okay, investor sentiment and economic environment, all these things, it actually it sets the market conditions. Since it is differing periodically, obviously market conditions might be the next other factor for this trade-off theory. Next. So debt versus equity financing. So debt financing, equity financing, two major things. See, since we discussed this in the first slide, see again, equity financing, raising capital by selling the ownership stakes. That is the equity financing through IPOs or even private equity, we can say, or even venture capital. Whereas debt financing is something that you are borrowing money from the lenders, or we can say bond investors, banks, or any financial institutions. Okay, so obviously we have to pay interest along with the principal amount. So that is separate. So that is what debt financing. Okay, and determining optimum capital structure, how to determine? First point is determining capital, company's financial situation, first thing, correct? Analyzing the cost and benefits of debt and equity financing, the second thing. Evaluating company's industry and market conditions, and fourth is assessing the company's growth and investment plans. By means of doing all these things. Definitely optimum capital structure that we can frame inside the company. Okay. So hope you all understood. Thank you.